Good morning, everyone from Glasgow, and a good day to our online audience. Thank you very much for joining our session this morning on scaling up financing for a net zero transition and achieving the goals of the Paris Agreement. My name is Shomik Lal. I'm a lead economist at the World Bank working on issues of climate and development, and I'll be your moderator for this session. I'm really delighted that we are joined here by a really distinguished panel this morning to give us distinct perspectives on private finance, on the interaction between private finance, public financing, and the role that markets can play in supporting a net zero transition, as well as enhancing adaptation and resilience. What we do know around the world when we look at the numbers is that there are major financing needs for countries to get to net zero. And we need to think more broadly about private finance, institutional finance, as well as the public policies that really lay the foundations for economy-wide reforms. We need the combination of all three. And public spending often is thought to be the golden bullet and the silver bullet, but it is not the only answer. We need to think about private financing. We need to think about private financing at scale. But right now, when we look at the global financial flows, we know that the private sector, it manages about $210 trillion in assets, but only a very small share is allocated to climate finance. And today, what our panelists are going to do, they will discuss the importance of attracting and aligning private finance with the objectives of the Paris Agreement. But while we think a lot about mitigation, we also need to give equal thought to adaptation. And here we need to think about individual coping strategies, about the role of public interventions, as well as market-based instruments. And here the real challenge for us is that while we have some resources for mitigation, the global finance for adaptation is far, far behind. And you know what, folks? The demand for adaptation is only increasing. In fact, the estimates suggest that adaptation finance is around $30 billion a year, while the need for adaptation finance is closer to $300 billion in 2030, $500 billion per year in 2050. And this is particularly challenging for our citizens of developing countries and low-income countries, where adaptation needs are the strongest and the greatest, but capital markets are the weakest. And this really makes it challenging for the private sector to come in and find really viable investments. So what I'm hoping in this session we do with our panelists here in Glasgow, our online panelists, is to figure out pathways through which we can think about private finance more broadly for mitigation as well as adaptation. And we have an incredibly rich panel here today to take these conversations forward. So first, I'd like to invite Mr. Michael Hydra, who is the Deputy Treasurer General of the Netherlands. He's going to join us online. And he is, hello, and thank you for joining. He is he's responsible for Dutch financial markets, looking at sovereign bond issuance, state holdings, export credit insurance, and international financial institutions. So welcome, Michael, to this conversation. So I'd like to ask you about how you started off with the cooperation between the Dutch government and the financial sector, and how did you come to having, in terms of the climate goals contribution and alignment, and more importantly, what are some of the methods that are being used from the government's perspective for harmonization, both on the national and international scales? Over to you.
Thank you very much, Chair. It's an honor to be present in this section. This is indeed, as you say, a very important subject because we all know it's not just public finances, but especially private sector financing that we need to achieve the transition to a green economy. And not only for green financing itself, we know that out of every single euro or dollar of public finances, we need 5 or 6 euros or dollars in private finances to make the transition successful, but also for all the existing non-green activities within the financial sector to ensure a pathway to phase these out. So what did we do? In 2015, we started with a so-called Dutch carbon pledge. This cooperation actually resulted in a sector-led development, and we achieved one of the most frequently used methodologies for measuring GHG emissions using the Partnership for Carbon Accounting Financials, PCAF. In 2016, we built on this initiative with the private sector with a platform for sustainable finance. Also, the regulator, in our case, the Dutch Central Bank, was involved. And I think we all now have these kind of platforms in our countries, and we build upon these platforms to create the international network for greening the financial system. Building on the 2016 experience, in 2019, we started with our current approach. The Dutch climate commitment has 50 participants from the financial sector, banks, pension funds, and insurers, and it has 3 major pillars. First, a commitment to the goals of the broad Dutch climate agreement, which means financing the energy transition. So this is the green financing component. Secondly, measuring the CO2 intensity of their portfolios from 2021 onward. And thirdly, developing and publishing action plans to reduce the financed GHG emissions from 2022 onwards. Well, our first progress report focused on the second pillar, but if I focus on the main findings of the recent report, there are 3 that I want to highlight. The first is that 89% of the participants report their CO2 intensity in detail. So this is much higher than international peers do. We saw the FT article yesterday that shows that only 21% disclosed the carbon emissions in their sector. So having a commitment, having all stakeholders together in a platform is especially helpful to get this high level of compliance, or this high level of active participation by the financial sector. The second main finding is that 68% of the assets are considered relevant to be taken into account, and 79% are covered by the CO2 reporting of the assets. Well, what does that mean? Because also in the FT article, we saw a wide variability of assets that financial sector participants measure. Well, we see that we need much more guidance and interaction between the financial sector parties, and ultimately some common guidance on what kind of assets you need to include. Otherwise, it's not going to work. Just having a framework is not enough. Knowing how to apply it and to continue the dialogue about that is especially important. Finally, we see, even in our own financial sector, a wide variability of reporting on relevant asset classes. The financial sector party that reports the least number of assets reported 20%, the highest reported 94% of their assets. Even though they use the same tool, they all use the PCAF reporting methodology. So here you see and that a lot of work is to be done to narrow the gap. There will remain differences between institutions and their assets, but we need this strong interaction and further guidance on applying the methodologies to ensure that we have a very broad perspective and broad compliance by the sector on reporting. Thank you very much, Chair.
Thank you. Those are very useful insights, and I think in the Q&A we're going to come to how do we move from measurement to action. But let me turn now to Jakob. Thomas, who is the Managing Director of the 2-Degree Investing Initiative. Jakob, much of your work is looking at these methodological innovations and PACTA. So can you give us a flavor of the challenges with current methodologies and tools focusing on alignment of financial flows with a low emissions development pathway and the role of PACTA here? You are free to use presentation or a dance or any other medium you would like, right? So.
Yeah, I will spare the interpretive dance to explain an alignment methodology, but perhaps for next time. So thank you as well from my side, obviously, for the opportunity to share our experience working on alignment methodologies over the last 6 or so years. It's really been an incredible journey from when the Paris Agreement suggested in Article 2.1c that aligning financial flows is the way forward, and the lack of methodologies to actually measure progress against that. And I think we've really come a long way since then. Yesterday, we're really pleased to publish a report that did a stock take of alignment methodology applications and alignment assessments of national financial sectors. We now see those assessments in 16 different financial sectors around the world, even at state level in the US, in South America, and Asia, and Europe. And they've covered now in the last 3 or 4 years over 2,500 financial institutions. So government supported, whether in partnership with industry associations or with central banks or supervisors, have led to over 2,500 financial institutions measuring the alignment of their portfolio with climate goals. And that obviously adds up to quite a lot of trillions in assets. That doesn't mean they're all aligned. And we've obviously been privileged with the PACTA tool that we've developed, which is an open source tool, freely available and freely usable actually to support that. I think the second thing I'd say is that often we talk about these projects, and I'm sure here are many panels you hear about these initiatives, but one of the things that's incredibly exciting is how the transaction cost of doing this has gone down a lot. And I think that's obviously so important, right? We can't spend all of our resources on measuring, and especially if we want to get to a sort of a globally coordinated exercise, we need to have something that is accessible from a transaction cost perspective. And so that's where the costs have gone down dramatically. For many asset classes, it is effectively now a matter of a few hours of somebody's time to run their portfolios through a tool, get the results, and see the alignment of their portfolio across key asset classes and sectors. Even in commercial banking, where you're dealing with maybe hundreds and thousands of clients, we have worked with the large commercial bank in the UK, Standard Chartered, which obviously has a lot of investments in the sub-Saharan Africa and in Asia. They've been able to analyze their entire corporate loan book in 3 to 5 working days. So that is really something where it's so important that this has changed. I know, Gabriela, you can talk about Switzerland, but when Switzerland conducted this exercise, we had 1 million securities, over 4,000 portfolios, and again, these were all automatically processed. The third point I make is that obviously alignment is just one step, or measuring alignment, to getting to actually understanding the contribution that financial institutions are making, right? And I think that's where the repetition of these exercises has just been incredibly fascinating to see, is that you can not just see how the portfolio changes over time, but coupled with an understanding of institutional investors and banks' strategies, you can see how those changes have actually been driven by engagement strategies or divestment strategies, or even other types of approaches to pushing climate finance, as you said. And I think that's really helpful for governments to not just understand the alignment, to actually understand which systems work. So I think those have just been really, obviously that's the upside. Now, as we go to the alignment methodologies, it's important to be clear-eyed about what are the sort of gaps moving forward. So I think what we'll see in the next 1 to 2 years is climate data for SMEs scale exponentially. That's clearly a gap in the market right now, but technology is really allowing us to overcome that. We think in Europe alone, we'll be able to move towards several million SMEs being covered by climate data sets in the very near future. The second key thing is the sector coverage, and that's particularly important in certain geographies, particularly agriculture and forestry is clearly an area where not just on the climate scenario side, but also on the environmental data and alignment side, we see gaps. So you mentioned PACTA, this tool that has been used in these 16 jurisdictions. So the PACTA tool doesn't cover agriculture and forestry, and that's a huge gap. We need to be transparent about that and recognize that that's a major challenge. It covers around 80% of CO2 emissions, but obviously that's not the whole ballgame. And then finally, I think we need to find the right balance between convergence and allowing for the different countries to do different things. I think what's really exciting in these 16 different jurisdictions, you have examples of industry associations leading the process, central banks, environment ministries, finance ministries. So it's not just a one-size-fits-all in terms of what fits best the market. Sometimes they just focus on banks, sometimes on the insurance sector. So really understanding that local financial sector well is super important. And I think as we look at the further development of PACTA as a methodology to help drive that approach, we will continue to want to try and allow for that diversity, but create a common platform, and that's what that stocktake does, to make sure that we do understand the differences in the results and the extent to which we're making progress on the Paris Agreement.
Jakob, these are useful insights, and they have great relevance for the work that our next panelist is going to talk about from a developing country perspective. And in the Q&A, I'd like to come back to you about how fund managers, when they use such tools, what is their extent of risk aversion towards places that may be weak in capacity but really need these resources but may not be complying very well. But we'll come back to that.
Of course.
Now let me turn to our panelist from Ghana, Mrs. Tucci Iwobi, who is the CEO of the Ghana Commodity Exchange. As we had set up this conversation, we have these tools about mitigation, but an equally important area is adaptation, and adaptation in developing countries. Mrs. Tucci is a thought leader, and she writes on leadership and is a contributor to the Harvard Business Review. And she is the CEO and the founding member of the Ghana Commodity Exchange. Welcome to the panel. It's really good to have you virtually. I'd like to kind of hear from your perspective. What do you see as being the main barriers for private sector investment for climate adaptation? And what is the role of your commodity exchange that you had in de-risking private sector investment for smallholder farmer value chains? Please.
Okay. So maybe it would be beneficial for me to just spend a couple of minutes talking about the commodity exchange and what it does and the interventions. It is a key participant in the agricultural sector in Ghana. It was set up by the governments of Ghana a few years ago, and it's really there to intervene at post-harvest level of the agricultural value chain. So we provide an electronic trading platform, so people come to trade electronically through the exchange, smallholder farmers, commercial farmers, and you have large-scale industrial buyers as well coming to buy on the exchange. So we're really linking buyers and sellers of agricultural commodities to the market. And we also run warehousing operations, allowing commodities to be standardized, graded, and really bring this quality to market. One thing which is really notable about the role of the exchange is that it's starting to help in the area of de-risking, agricultural lending, for instance. So commodities that come into the GCX warehouses are insured, not just the physical structure, but the commodities themselves are insured. We have performance bonds on them. So we really do guarantee that what the seller brings in is what they keep, and what the buyer is looking to buy is the quality they're asking for, the quantity they're asking for. So we put in all these, mitigating factors. This is allowing banks and other institutions to get more confidence in the agricultural sector. Today, lending is, less than 5% towards agribusinesses and financial lending. But with, institutions like the Commodity Exchange, these commodities, or let's say the electronic warehouse receipts that are linked to the commodities, are recognized now as securities under the Securities Industry Act. And so now banks are confident, and the sector is becoming a lot more confident. Again, I mentioned that these interventions are at post-harvest, so we don't actually intervene as early as pre-production and production. So there are a lot of risks in this area. We are heavily dependent on climate change. Last year, we saw that drought came at different times of the year. This heavily impacted harvest, and it impacted buy and sell activities. And one area that we know is that there's very little insurance when it comes to, I'm sure my colleague will speak a little bit more on that later, when it comes to pre-production and production. So yes, on one instance, there's lack of information or lack of sufficient information regarding some of these impacts on the climate. And at the same time, there's a little very little understanding in terms of, what is the return on investment if private sector wants to, spend, finance adaptation and so on. What are they going to gain in the short term? So there is a lot of work to be done in this area. We are working with other institutions. I mentioned that the Ghana Commodity Exchange is one player in a very large ecosystem. So we're working with other institutions. We have currently, for instance, a project ongoing with the World Food Programme, which is seeking to raise financing for up to $150 million from other DPs, development finance institutions, governments, and private sector in areas such as grants, but also equity investment, really for adaptation, whether it comes to infrastructure or other climate activities. And this is really seen as a key to solving, sustainability, improving growth, development of this all-important sector. So I hope that gives a little flavor, but there are really a lot of areas that need intervention, and some private sector participants are starting to play at least a key role in some of the areas. But let's say the challenge remains large, especially when it comes to funding.
Thank you very much for those insights. In the follow-up, I'd like you to kind of come in and think about the role of the public-private partnership downstream, but links with insurance markets upstream. So let's come to that. But now let me turn to invite Mr. Mohamed Katu, who is the CEO of the Ghana Agriculture Insurance Pool. Welcome, Mr. Katu, to the panel. It's very good to have you.
Thank you very much.
And it's very good to see two different perspectives on adaptation from Ghana. One kind of looking at the public-private issues and the work you're doing on insurance. So I'd like you to give our audience a little bit of a flavor on how effective the GAIP has been in providing insurance-based risk management for climate adaptation.
Thank you very much, Mr. Moderator. As you rightly said, climate change adaptation is quite key to Ghana's agriculture sector because the role agriculture plays in this country is very, very important. Its contribution to GDP and other areas of employment and other issues. But unfortunately, the climate change is adversely affecting the production of agriculture in Ghana. And that is where the challenge comes in because as my colleague said, they are looking at the post-harvest area, but what of the production section? That is where we have the difficulty. And because of this production risk, agriculture is perceived as a high-risk venture where investing in these areas are always a challenge. That is where Ghana Agriculture Insurance Pool comes in. Let me just take this opportunity to throw a little more light on what we do and what we bring to the table. The Ghana Agriculture Insurance Pool is a body set up by the Ghana Insurance Association, representing the non-life council of the association, with about 17 members coming together to form the pool. The idea of the pool was that we have a lot of non-life insurance companies in the insurance industry in Ghana, which is regulated by the National Insurance Commission. We have life insurance companies in Ghana, but none of these companies was doing agriculture insurance. So that was the missing link. So that's why the idea came that, okay, why don't you set up a pool? Because the other members do lack the exposure to agriculture insurance, which is a specialized area. So that's how Ghana adapted the pool system, where we can work and produce innovative insurance products for the adaptation of climate change. So this was in collaboration with the regulator and GIZ, that's the German Development Corporation, and the Ghana Insurance Association that established the Ghana Agriculture Insurance Pool. So what we do is to provide insurance for the production sectors of the value chains for both commercial farmers and the smallholder farmers we are talking about. And with the passing of the Insurance Act 1061, that the Insurance Act of 2021, regulating insurance industry in Ghana, index insurance is recognized at Section 210 of that Act. Then what we try to do is that because of the climate change adaptation technologies are very expensive, and it's very difficult for farmers to adapt these technologies, though it has to help us to improve upon the performance or the food security of the nation. So in that vein, what we try to do is to give them the necessary.
Did we lose the connection? Did we lose the connection? Okay. I'm sorry, it looks like we have lost the connection to Ghana. So while we're trying to get Mr. Katu back, let me turn to Mrs. Gabriela Blatter, who is the head of the Environment Unit, Environment Finance Unit in the Ministry of Environment in Switzerland. So I'd like to come back to issues of measurement in this conversation. And so we'd like to hear your views on the comparable and science-based disclosures that you think are really needed to support a forward-looking alignment of private finance with the Paris goals, but more also help us understand how Switzerland is getting its actors to, in the financial sector, to align their portfolios with Paris Agreement.
Thank you so much, and good morning, everyone. So I think in terms of what kind of metrics do we need, or what kind of measurement technology, measurement methodologies, as already Jakob pointed out, I think we need probably a variety of methodologies, and we have to be very aware of what we measure, what we want to measure. And for us, it's really important that when we talk about alignment, we also really measure alignment. And what we have learned in the Swiss case is that through the PACTA methodology, we are able to assess where the different actors in the financial sector stand within Switzerland. It helps us. So they're not all of them are aligned, clearly, we also know that very well, but at least it gives us a measurement point and trying to understand where they are. Now there's also the conversation about taxonomies, for example, and I think they're very helpful for assessing, for example, green bonds. But because they only assess whether something is green or not green, you kind of miss the shades of brown or shades of green, however you wanna phrase it. Whereas if we take measurement technologies or methodologies like PACTA, they help us to get the speaker is back online. So maybe we'll...
No, why don't we
Great.
work through yours
Okay.
back and then go back.
Perfect. So I think those, they help us to also cover these shades of gray or green. In terms of adaptation alignment, there we still see quite a big gap, not so much action going on. I think this is also linked to the fact that when we talk about materiality, in the space of mitigation, there might be a conflict of financial and environmental materiality, whereas on the side of adaptation, we actually feel the environmental and the financial materiality are very much aligned because we talk about risk exposure. And so maybe that's why there hasn't been so much action, because there is already a lot of work going on around financial materiality for that space.
Thank you. Let's go back to Mr. Katu for a couple of minutes to complete his thought before we come back to a round of conversation here. Mr. Katu, if you can hear us, we'd like to just hear your kind of views on the GAIP. As you were wrapping up, we sort of lost the connection.
Thank you very much. Sorry for that. I think my line went off. Yes, so what we are trying to see is that GAIP is trying to provide the protection for the stakeholders so that we enhance the resilience of the value chain actors. For example, we are looking at the financial institutions who are bringing private capital into the investment into agriculture. And because agriculture is perceived as high-risk venture, as I mentioned earlier, there's kind of skepticism, or people are not willing to go in there. So those who will master courage to go in there charge higher interest rates. So we are trying to see how we can bring insurance to cushion that effect so that they'll have the comfort to go into agriculture. Then when it comes to the smallholder farmer and farmers at large, how do they also adapt climate change adaptation? For example, the NDC action project for Ghana is solar-powered irrigation systems, which comes at a cost and is very difficult to adapt, because that's an answer to the irrigation challenges we have in the country. But if farmers cannot adapt it, because of its cost than what comes in. The farmers are not comfortable adapting it because if I take the irrigation system and there's excess rainfall and I lose my crop, or there's outbreak of diseases or whatever, and I lose, or windstorm, I lose my crops. In that case, how do I go to pay back the loans or facility I've contracted from the bank? So this is where the insurance comes in. So the insurance works hand in hand with the financial institutions and with other partners like Gisel Limited, which is a company set up by the Bank of Ghana and currently owned by the Ministry of Finance, who provide guarantees to the financial institutions to stimulate lending to agriculture. So this is how we come in, so that we can all work hand in hand, so that the farmer will be resilient, the financial institution will be resilient, as well as the other stakeholders like processors who run agro or in-grower schemes with the smallholder farmers will also be protected. So insurance provided by GAIP, that's the Ghana Agri Insurance Pool, plays a major role in this financial model, which results in the affordable facilities for the adaptation to climate change technologies. Let me end here so that we can continue. Thank you very much.
Thank you very much. I'm glad we could get you back. Let's maybe have one more round with our panelists before we turn it to our audience. So if I could turn to Mr. Hydra, I hope you're still with us. I think a point you really made that was very useful was on climate impact measurement. But how do we move from there to real climate action? And there's a lot of leadership here that the Dutch experience has shown us. So maybe you could help us, help the audience understand the Dutch experiences with climate commitment of the financial sector.
Thank you very much, Jared. This indeed is the key question. And we need to move from commitment to measurement to action. Yeah. So we had a lot of commitment from the sector right from 2015 onward. That translated in a lot of measurement. As I told you in the earlier round, almost all sector participants participate now also in the measurement. But the key question is, how do we get from measurement to action? In our case, we now have more than 50% of the participants that translate the measurement into a concrete action plan. And that differs for each financial institution, what is their way to engage with other parties to achieve climate neutrality of their portfolios. For some, for instance, pension funds and insurers, they can be active as shareholders and vote in the shareholding procedures or put something on the agenda of the shareholder meetings. For others, it's financing green new loans. As for the banking sector, it can also be disinvesting from fossil projects, and it can also be further engagement as lender with corporates to enable them to finance their own green transition projects. What we saw recently is our largest pension fund, which is ABP, which holds about 500 billion euros in assets, said and announced that they would abandon all fossil investments from next year onward. So it is key to have these action plans, and each institution will choose its own mix in line with their strategy. But transparency about these choices and having all sector participants commit to these action plans so that you can have comparable plans from the institutions is the next step. And by having this platform where sector parties can discuss their action plans and making these action plans public will ensure that there is public transparency, that there's public pressure, and that the sector can learn from each other how to best achieve good action plans. So we prefer this to an approach that relies on legislation, which is usually slow, a more a tick-the-box exercise, instead of this active engagement within the financial sector, where all stakeholders are involved, the regulator, the Ministry of Finance, other participants that look at the commitments made by the financial sector. And this, in our view, really helps to bring forward the goal of a net zero transition. And ultimately, this is the next step that we are taking. We had a COP on biodiversity just a few days earlier. And one of the key goals, of course, of this net zero transition is to protect the biodiversity. So this is not just a single step. We need to move forward, and also in the area of biodiversity, because their losses are truly irreversible, to make sure that with the net zero alignment, we achieve biodiversity in the future. Thank you very much.
Mr. Hydra, you raised a very important point, that it's not only command and control regulation. We need information, and information that pressures companies and financial institutions to make reform. And I think this is a very interesting paradigm shift, which I think relates, Jakob, to the point you have been saying about PACTA as well. But could you give us some illustrations on how PACTA can help governments and actors in the financial sector align the financial flows? If any specific examples would be very useful.
Sure. So I think, as I mentioned before, the first way this helps is, to be honest, to save up more time for the actions. And for many years, once you were done with the analysis, it was kind of like the year was done, and then you didn't have time to do anything with the results. And that's really critical. So as you know, as my organization, we've developed this PACTA tool. When we run these alignment exercises, it really is like a what's the word in the car factory, like really like you're just putting the car together smoothly, and that's how it works, like on a factory line. So financial institutions, the governments make it a voluntary exercise, but as highlighted by the colleague, we see in many countries upwards of 80% of financial institutions participate, even though it's voluntary, because it's so easy to do. You create an account, you upload your portfolios, all the security systems are calibrated to make that doable. We really are able to do that with all types of financial institutions. And then you wait 3 months and you have a cup of coffee, and then you get your results. And you get them comparable with every other or 3 months worth of cups of coffee, but you get them comparable with,
a lot of coffee.
with every financial institution that participates. And I think the other piece is also that, you know, we're really trying to help financial institutions then after that process understand what actions they can take. And we know that they take actions. We have the evidence across these different markets that they take actions. In Switzerland in 2017, when this exercise was run for the first time, we did a survey the year later. 40% took actions on the results. So that doesn't sound like a lot, but 20% were actually already on track, which maybe could have been better, but still. And we have another 20% who said they have, you know, this was interesting, but we're going to take different types of actions because we learned something here that we wanted to go in a different direction. So we actually see that. We saw that in the follow-up results. Those institutions that participated the first time took actions, had better results over time than those that didn't participate in the first time. And I think that's really important. Maybe just a brief final point. I think there's actually a fourth step, which is from financial institutions' actions to real-world changes. It's not necessarily a one-to-one. You can divest, but maybe not really drive real-world decarbonization. And I think that's where we're really also seeing a lot of interesting lessons about that. I don't know actually if you want to jump in on that experience that you had in Switzerland about that, but I think it's really that final step is becoming front and center about really making sure how real-world changes are triggered by financial market actions.
So let me turn to Gabriella to provide some insights about those real-world changes.
So based on the exercise, we actually saw that those institutions that some said we went for full divestment, and then we looked at their portfolio, and actually none of them actually had full divestment, which is quite interesting to see. So there still seems this big data awareness or gap that they themselves don't really know all into the details what's in their portfolio. But then what we also saw is that institutions that did say they have a divestment strategy and they went for engagement together overperformed significantly over everyone else. So it's really nice to see that once you do something, you're getting a little better. If you do two things, you're actually getting a much better, right? But what we also still don't know, and that's where also we're engaged in research activities with the OECD and other institutions, is to really measure, well, if you divest, does it really have an impact or not? And we're doing assessments around ESG and alignment, which is what most, as institutions are saying, right, we're going for ESG alignment, and now we're doing all these activities, whether that really has an impact. And so we're doing that really evidence-based research. And the first insights we have is that we do see an impact when an institution jumps from one labeling to the next, so that, you know, from A to B or something. So in the jump, where it has an impact on the jump, we do see quite a significant impact, and the stronger and clearer investors communicate what they will be doing if X is not happening, the more impact they actually generate on the ground. So that's quite interesting as well to know.
So I'm going to follow that up with a little bit of a controversial question. Let's say both Jakob and in these views, let's say investors really take these seriously, right? And saying, okay, I'm risk averse, I'm going to follow ESG goals, and I'm going to divest. So does it lead to, do you think we are running the risk of huge capital outflows out of countries where governance standards are very low, which may be the weakest countries and the poorest countries? So do you think this may exacerbate global inequality?
I think the risk is definitely there. I think denying that risk would be being naive. There's a couple of things that are really important about these exercises that try to mitigate that risk. One of them is that the scenarios are regional. So that means a Swiss investor who's invested 100% in China, which obviously isn't the case, but bear with me, and 100% in China, will get a Chinese scenario where, for example, the coal power trajectory is very different to a European scenario. And the investors aren't necessarily always very happy about that, but that ensures that you get the regional profile in your alignment exercise, and you're not, you know, an emerging market investor isn't being measured on the Swiss national decarbonization plan. I think that's one important mitigation measure. The second one is that we trace assets through the system to reveal whether this is happening. So that means that if you're, you know, if you're engaging with an oil and gas company and they sell their assets to another actor, or you're moving out of an emerging market company because of the profile that you don't like, if we don't see the asset profile change, you're not necessarily getting rewarded for that over time. Now that's complicated. It's sort of I don't think we're there yet, but what we're increasingly being able to do is to actually say, look, only if the asset profile changes do you get rewarded. And if you've simply moved the deck chairs on the Titanic, your portfolio will look better and the results will reward that. But as we're thinking about the national assessments and the impact assessments, you don't get rewarded for deck chair moving.
And what we also, because of this linkage that we saw with if investors very clearly communicate, so what we saw in that study we're undertaking, still ongoing, is when an investor, for example, says, I will divest if X, or if you're not doing X, then it has a true impact. So I think where we're trying to go is that investors don't say, oh, this is too risky, let's just divest, which I understand is a risk, and I would also agree with that. But then engages, for example, with an energy company, let's say in South Africa, to say, you know, we really want you to move out of this coal plant and to invest in this like future technology, which will also generate local jobs, green jobs, and so on, and engage with them and say, if you're not tabling us a strategy how you'll get there in 5 to 10 years, we'll divest. And that will have the true impact, and it will also not lead to, we don't want assets to leave from South Africa, but actually drive those assets towards change and towards the transition, which is also more sustainable for South Africa.
So I really appreciate these insights, because there's a lot of confusion in how people perceive the impacts of these sort of measures. So let me turn now to our colleagues in Ghana, and I hope you're still connected. Mrs. Tucci, in your remarks, you mentioned the role of the commodity exchange in de-risking private investments. But also, could you elaborate a little bit how the exchange helps in getting access to services for small holders and improving market access?
Sure. It's, you know, the exchange is actually regulated by the Securities and Exchange Commission. So there are a lot of checks and balances, but at the same time, it's very open. The reason the government decided to invest in the commodity exchange, you know, from the very beginning is precisely because of this social good, to really help smallholder farmers improve livelihoods, increase incomes. And so it's a membership-based organization, but the first focus for us when we established, and again, I mentioned the government, put in the funds to set up the exchange, but it's actually been set up as a private company, limited by shares, designed to really become a public-private partnership. We just wanted to make sure that we really look out for the social good elements before we start bringing in investment. So we're moving on to the second phase now, but essentially it's membership-based, and we encourage farmers. Of course, smallholder farmers in Ghana, you're literally looking at a 1.5 hectare land, which is doing, very low yield. So in terms of production, it's not high, but they come together sometimes in farmer-based organizations, in cooperatives, and they can actually come and trade through the commodity exchange. You need a minimum of 1 metric ton to trade through the exchange. So if you can gather a metric ton of your grains, you can trade through GCX. So we support them, we support the process. They are, exposed to a price discovery mechanism. We give price information at the end of every trading day. So we send to all our members, including all the farmers and all the farmers in the network, the actual price information of commodities that were traded by grade. So they understand that you can get a premium price for higher quality commodity. And at the same time, they're exposed to that. They do not pay for any of the services that the exchange offers until after they've traded their commodity. So we're really allowing this institution to provide this access not only to our services and our products, in a very easy to use manner, but also then access to markets which hitherto they were not able to experience, as people just go to farm gates and purchase commodities at whatever price, regardless of quality. So these are some of the interventions that we're taking. And we talked about things like, the insurance and all those guarantees the exchange puts in place to mitigate risks for the private sector who want to participate, and at the same time protects these smallholder farmers. So it's really a priority for us. We started with grains, with food security crops, and then we will be moving on to other, cash crops and so on in the very near future. So I hope that, gives a flavor to how we're really trying to support the market. We're doing it very effectively when it comes to this stage at post-production. Again, more work needs to be done with other partners in, pre-production and production stages, but we're seeing some progress in this area.
Thank you very much. I think that's really helpful. Let me ask a question to Mr. Katu. In your intervention, you talked about these insurance-based risk management solutions for climate adaptation. So I wanted to get a better sense of the sort of information collected by your group so that we have better risk pricing, and how is the information collected for these insurance products?
Thank you very much, Mr. Moderator. I think that's a very good question. Actually, with agriculture insurance, you normally need a historical data before you can do anything like the risk pricing and other things. And we have institutions in Ghana who has been gathering all this data from the Ministry of Food and Agriculture, that is the Statistics Research and Information Directorate, the Ministry of Food and Agriculture. They have all the yield data and other things which we require in developing products like area yield index insurance, which normally deals with the yields in a particular geographical location and other things. Then we also have the Ghana Meteorological Agency, who is in charge of having rainfall data and other necessary data we need in also coming out with our designing of index insurance for maybe drought alone, that kind of thing. So we have institutions which are in the country who provide such data. Then we have other institutions like the Ghana Space Science and Technology Institute of the Atomic Energy Commission, who also does the same thing. And also they even do crop cut exercise, where the assessment or estimation of yield data, which SRAID also does, so that we can, at the end of the season, we can also have data which we can use to measure the performance of the season, where if the farmers, based on the threshold we've set, the triggers we set, qualify for payout or not. So these are some of the institutions we leverage on them for data so that we can equally design the risk, risk pricing for our products. So this is what we normally do. And the end effect is that we try as much as possible to reduce the effects of basis risks to the farmers so that at the end of the day, the products that we churn out will be attractive to the farmers so that at least when they suffer a loss, they should be able to be compensated, and that will create the comfort they need in assessing facilities for the climate adaptation and so forth. Then we also provide the same comfort to, for example, the financial institutions. Here we are talking about how they can bundle agricultural insurance with their products, like what they do with personal loans, coming with life insurance, auto loans, coming with comprehensive insurance on the vehicle that they are financing. So any financing they are giving to a farmer, there should be an insurance that goes with it. So that will give the comfort so that if the farmer is not able to, due to the occurrence of the risks, insured risks, which not through the fault of the farmer, the insurance will come in so that the farmer will be able to make repayments so that that private funding going to agriculture will be sustained and the financial institution also be comfortable. So like the model I mentioned in my earlier presentation, we are trying to see how we can bundle guarantees from GESAL, insurance from GAIB, then the facility from the bank, all coming together so that we give the farmer or all the stakeholders the enhance their, their resilience, which they need in going into that sector. So that's what happens.
Thank you very much, Mr. Katu. That was very helpful on the role of information in making a lot of these insurance markets work. So we have had some really good conversations here with the panel, but I'd like to now turn it to you, the audience. And let me start by colleagues in the room who have any questions. And then I'll ask Lauren to tell us if some of the online audience has put in questions in the chat. Colleagues, right here.
Yeah, sure. Oh, thanks. Hi, I'm a delegate from a small island jurisdiction in Canada. We are right now encountering a lot of enthusiasm for more like on the project side. Land use holders are interested in getting involved in climate mitigation operations, and they're seeing carbon-based financing as an option, which is like opening up a lot of as a mechanism which is opening up a lot of options for them. And they're interested in the voluntary market because it's available to them right now, but they're apprehensive about things changing in the not too distant future. Could you distill like a comment down that you would inspire confidence in those buyers, that you see a future here and that maybe the voluntary market will be the mechanism that persists? Or do you think that that's the case?
Do you want me to?
Yeah, well, okay. I think Jakob and Gabrielle.
Okay, so yeah, you're speaking to the carbon markets, so implementation of Article 6, of course, a very key issue here at the COP. As you may know, Switzerland and the Environmental Integrity Group is very eminent on that side. And so I would tell your shareholders or your stakeholders to say, yes, we're confident that we can come to an agreement here and we can come to an agreement on ambitious rules. I think what's important is that the voluntary carbon market also follows, so if there's no agreement on 6.4, that they do follow robust rules under 6.2. And for example, from Switzerland, what we're providing is we have these bilateral agreements if 6.4 also is not formulating, which has very robust rules. And we do provide under those architectures additional space for projects which are credible, do not lead to any hot air and no double counting. So I think what's really important is that if you go for the voluntary market, ensure that there's no double counting and that it's credible and really creates an additional benefit for the environment. Yeah, I think that's, but I would be confident that that's happening.
Do we have any online questions?
One question.
Please read it out, yeah.
So, thank you very much to the speakers for this There's a question to... Oh, thank you very much for this rich dialogue. There's a question for the speakers in Ghana, and this relates to the insurance products, the guarantee products that are available for smallholder farmer resilience and to support them in their adaptation interventions. A question is that whilst these initiatives are being formulated and are available, what we're seeing on the ground many a time is that the aggregation of the opportunity and the beneficiaries, the smallholder farmers, is not happening. And the access from the ground up to these insurance and guarantee products is not very effective. Is that a reality that they see in practice? And if so, how are they trying to put in solutions to deal with them?
So we just have a minute on this. Should we come back to our colleagues in Ghana, Mrs. Tucci and Mr. Satu?
Okay, I think I will take it. Yes, you are right. In most cases, some of these things happen, but what we are trying to do in Ghana is that with the collaboration between GITSA and some of the financial institutions, the interest rates of its partner banks have started coming down, unlike the commercial rate they used to charge because of the guarantees they are experiencing. Now, with the insurance coming on board, added to that, is going to bring the interest rate further down. That's why I said in the model, we are trying to see how the insurance will be added to it to make it more affordable. Now, when you look at the Insurance Act 1061, Section 245 to 249 is clearly spelled out the establishment of Agriculture Insurance Fund. And what this fund is going to do is to support farmers in payment of premiums and other logistics, for example, setting up the infrastructure for the provision of agriculture insurance in Ghana, and also the extension officers from the Ministry of Food and Agriculture going out there to educate farmers on all these things. So these are measures, institutional arrangement put in place, which is by law going to help to bring the cost of the insurance down. So
Thank
if
you,
the cost of
Mr.
insurance is
Kauchu.
down,
We are running out of time. So I'm
Thank
going to
you.
give 20 seconds to Mrs. Tucci for any closing remarks, and also to Mr. Hydra.
Okay, so maybe just to close, just to talk about the importance of different organizations and institutions working together. We've been collaborating with the NDC Action Project here in Ghana. I've mentioned collaborations with DPs, DFIs. The job to be done is mammoth. I mean, even in response to this question, 60% of people are employed in agriculture. So for these products to really trickle down is going to take, a number of years. But we are starting slowly. It's like, the reason we're all together today to try to reach agreements on how we can really focus on adaptation and resilience. So
thank you very much. Let me turn to Mr. Hydra. 30 seconds.
Well, I can have 5. So commit, measure, and then action, action, action. That's it.
So thank you very much, everyone. We are coming to the close of this very exciting event. I think we learned 3 things here. The real importance of data and information that needs to be publicly accessible. Transparency and information, but also of moving from just information sharing, methodology development to real action on the ground. I really thank all my panelists, both here in Glasgow and online, and all the audience here and online for joining us. Thank you very much.